Takund March. These are your wonderful colleagues for December. These are your wonderful colleagues for December 2021 exams for Taxation Zim. And clearly, you know, as tax as a subject, it's a very easy subject, only to accept the fact that some of the figures and thresholds, they change from one session to another. Principally, the tax rate that we'll be using for corporate tax rate that we'll be using for December examinations is 24%, and the VAT tax rate is 14.5%. Apart from that, you can practice even earlier past papers, but only you need to understand that the rates have changed, and also some of the significant changes that we are going to identify in this particular lecture. I'm taking you through what we discussed last week, and because Takunda has joined us, it means I have to perhaps send some of the stuff that we discussed to the... Takunda, are you now in our WhatsApp class group for taxation? Like tax... If you can hear me, let me check anyway. Let me check. Okay. I trust you are the one who was added this afternoon. So it's perfect. So what I'm going to do, Takunda, is I'm going to add you to add material that I have sent to your colleagues in the earlier chapters. So that, okay. Okay, who else has joined us? No. All right, Tendai March, you. Okay, it's fine. What I'm going to do now is I'm sending the information that I gave your colleagues in the earlier chapters to this same class group, so that you can as well keep yourself updated. You play these videos and you will be up to date with your colleagues. Where am I? The good thing about these videos is you can see that they are YouTube videos. So this was gross income, valuation of fringe benefits, okay, etc. So this one is the first video. Well, I'm sending the same video to the same class group for you because you have joined just now. Okay, so there you go. I want to pick the other video as well. Lease premiums and lease improvements. That's the other thing that we did. I'm sending it to this class group so that you'll be up to date. And then the third video, the third lecture video that we had, is this one, which is lease premium exemptions and deductions. This video included quite a lot. It included even prohibited deductions. Wakamanzwisisa here prohibited deductions, Tendai? Yes, you noticed that this is a very long video. So these are the topics, these are the items that we have done for in our syllabus for taxation. And once you have played these videos, you are now abreast as with the syllabus as your colleagues. Okay, now let me open an Excel document here. Let me open an Excel document. Let me open an Excel document so that I take you through today's discussion. All right. It's opening. Don't worry, it's opening. Only that I don't use Microsoft Excel, I use WPS for the reasons that I like myself. You know, WPS can edit, you can use it to edit a PDF document into Word. It has got all these functionalities which you can use without paying any additional fee. Because of that, no wonder why I use that most often, because as a tutor I'll be opening a PDF document at the same time I'll be like making some computations, so I would rather open such documents on an Excel. All right. Okay, it's opening, guys. It's opening, don't worry. It's opening. Just a sec. So whilst this is opening, you do notice, Peter, that the videos that I've sent to you are on my YouTube account. So it's all you have to do is to subscribe to your SAYS YouTube video and you keep yourself updated. It's not even a train smash. Subscribe, you view all these videos. You know, the YouTube name is Colin Mupatsi. That's the name of your tutor. And Colin Mupatsi, Colin with double L. Mupatsi, M-U-P-A-T-S-I. And that's all you have to know. You can access all these videos and keep yourself updated should we have any new videos, etc. Oh, well. Let me open it again. It appears it's taking long to open. All right, now it's opening. No, I should have done this in advance of the lecture, only that I wasn't around. Normally I do the opening of this Excel document in advance of the lecture, but now it's opening, so excuse me for that. Ndarapita ndati maswera sei mbamangpa amene kamba kazongoukura mbamasiyana. Okay. Adam, how are you? Oh, ndiri right Ndarapita. Ndazongozwa kamba kachingoukura kamba mazongoti idikitira vanhu noise. Right?
I'm sorry for that.
Kwazina kudzidzira kumba kune ma-stakeholders ka. Kune ma-stakeholders akawandisa. All right. My document is finally opened. This was the thing which was taking much of our time. Let me zoom it a little bit so that you can see what I'm doing here. Okay, so here is a recap of what we have done. We have done gross income. gross income, and make sure you are in agreement with yourself. If not, you need to say give me the video on that. Gross income. The other topic that all these videos are obtainable on my YouTube account. We have also done exemptions. We have also done deductions, and we have done prohibited deductions, Okay, you have all these videos in our WhatsApp class group, especially the last one where we are talking of deductions and prohibited deductions. This one is not on YouTube, but it's on Facebook, and I'm sure I've sent you the Facebook link. If this is the Facebook link here, exemptions, deductions, together with prohibited deductions. So it's a very, very long video. So what we want to discuss today is a continuation of this. We now want to discuss. Remember, these are kind of our first 3 topics, and you can see we are moving at a very, very exceptional pace. It's well within reach that we complete the syllabus by the 28th of October. So today we want to discuss capital allowances. We want to discuss capital allowances plus computation of tax from employment and non-employment, So this is what we want to cover. Computation of tax from employment and non-employment income. So if you don't have notes to the extent of these topics, the first 4 topics that I have listed, please make sure you get these notes so that you be up to date with your colleagues. This, which is shaded in red, is what we want to discuss today. So let us start with capital allowances. Capital allowances. You may ask, what are capital allowances really? It's simple. It's nothing much at all. Capital allowances simply means this is depreciation for tax purposes. This is depreciation for tax purposes. That's capital allowances. What we consider is depreciation for tax purposes. So the variant of it is tax allowable depreciation. Tax allowable. That's the variant of it, which is TAD. Tax allowable depreciation. For you to better understand capital allowances, let me take you through what you already know. You know, because you know depreciation already. You know that there are various ways of calculating depreciation: straight line method, reducing balance method, etc. And there are various types of assets which are eligible for depreciation, and some of them which do not depreciate. Like, you know that land doesn't depreciate. So even for capital allowances purposes, we don't have tax allowable depreciation on land. You know, if you are an accountant who depreciates land, make sure, suppose you're an accountant and you proceed to depreciate land, you need to understand that from that moment onwards, accounting as a profession is not yours. You need to change. You need to see to it how you can navigate your career terrain away from accountancy. because you don't depreciate land. But what you may say, what if there is a cyclone and stuff and the land is eroded so that it's no longer like it's having its carrying amount than what it used to have. Under the circumstances, you test the land for impairment. We are teaching you that in financial reporting. So let me say accounting here. The reason is I want just to give a comparative table and taxation, tax purposes, taxation. Let's say taxation here. Right, so this is accounting, this is taxation. So for accounting, we do have what is called cost of asset. Cost of asset. In for taxation purposes, it is still the same. We call that cost of asset, nothing much. But you do notice there are instances we can say deemed cost of an asset, but still the same. I shall talk about deemed cost shortly. For accounting, we say depreciation. Depreciation. For taxation purposes, we say capital allowances. Capital allowances. Or tax allowable depreciation, TAD. Notice we said we call these capital allowances or tax allowable depreciation, which is TAD. And then for accounting, we say carrying amount or net book value. Carrying amount or net book value. How you calculate carrying amount or net book value? You still remember how this is calculated. We say carrying amount or net book value equals cost minus capital allowances. Oh, sorry, minus depreciation. Sorry for that. Cost minus depreciation. That's how you calculate carrying amount or net book value of an asset. It's a matter of saying cost minus depreciation. And by depreciation, we actually refer to it as accumulated. Not just depreciation for a single year, but total depreciation up to that particular period in time. Here, instead of saying carrying amount, we call it income tax value. Income tax value. You understand that? Which is better known as ITV, shortened ITV. How we calculate ITV? It's simple. You simply say ITV equals cost minus ITV equals cost minus capital allowances to date. Capital allowances to date. You get that? And another thing that we have in accounting is that if you make profit on disposal, let's say you've got profit on disposal. Profit on disposal. You know, profit on disposal, it arises when you sell an asset at a price which is greater than its carrying amount. Suppose, profit on disposal arises when it arises when selling price is greater than carrying amount. Let's say net book value. This is what you understand better. So that's when we say there's profit on disposal. Whenever carrying amount of an asset exceeds, the selling price of an asset when you dispose it exceeds net book value, we say there's profit on disposal. Now, for taxation purposes, we don't say profit on disposal. Rather, for taxation purposes, we say recoupment. So recoupment has got the same connotations as profit on disposal, but for taxation purposes, it arises when. So this is how recoupment arises when selling price is greater than income tax value. Here we don't say net book value, we simply say income tax value because it's cost less allowance, less capital allowances to date. Another thing that you need to know for accounting purposes is we do have what is called loss on disposal. Loss on disposal. Also, it arises when loss on disposal arises sorry, let me put it in bold like this. It arises when selling price of an asset, when you are disposing an asset, is less than its net book value. Meaning you're selling an asset at a price which is below the net book value. Under the circumstances, we say there is a loss on disposal. For tax purposes, we don't refer to that as loss on disposal. For tax purposes, we refer to that as scrapping allowance. So this is referred to as scrapping allowance. It arises when scrapping allowances arises when, so here you go. It arises when selling price is less than ITV. Are you not seeing there that for tax ITV it replaces net book value? That's oh sorry. Just a sec, allow me to answer this call. Steven. Yes, Sean. Panda pura. No, that same lorry was still parked. All right, it's okay. Just give me 2 minutes. Ndibate Moses. All right. Oh, sorry guys, just a sec. Allow me to call someone. Just a minute. Right. Okay. Sorry for that, guys. Coming back to my Excel document, you can see here that you can see from a glance that issues to do with capital allowances are not even an issue at all. They are not even an issue at all. These are issues you can really appreciate like this. So let me now have points to note. The main points to note. You can see that for accounting, loss on disposal, it's an expense for accounting purposes, but it's a prohibited deduction for tax purposes. So you can see here that loss on disposal of an asset, loss on disposal of an asset is an expense for tax purposes. I mean, it's an expense for accounting purposes, but is a prohibited deduction for tax purposes. Is a prohibited deduction for tax purposes. So when you see that business ilikunziro report a profit of so much, but ranga deduct a loss on disposal, what it means is you add it back. Why do you add it back? Because it's a prohibited deduction for tax purposes. It's a very important point here. Then profit on disposal of an asset. Profit on disposal of an asset. Profit on disposal of an asset is income for accounting purposes. But for tax purposes, we deduct it and compute recoupment in its place. So for tax purposes, you make sure that consider the profit on disposal. So ukaona paine profit on disposal, I see income for tax purposes. Unoto deduct in its place, we'll calculate a recoupment, if any. So the same part like pana. Let me insert and complete this particular statement so that you can have a clearer picture. Patiri kuti isusu loss on disposal of an asset is an expense for accounting purposes, but it's a prohibited deduction for tax purposes. So what it means is in its place we compute scraping allowance as a deduction. We compute scraping allowance as a deduction in its place. So these are important points for you to note. We don't have what is called loss on disposal for tax. Rather, we have scraping allowance. So if loss on disposal was deducted, you add it back, and then in each place you compute what? Scraping allowance. If you see profit on disposal as income, you deduct it. In its place, you calculate recoupment. This is one of the most important thing. So let me number these points to note so that you can follow through as to on which point are we. And then note number 3, recoupment cannot exceed allowances previously granted. Recoupment cannot exceed allowances previously granted. Recoupment cannot exceed allowances previously granted. What does that mean? It means night and day, tell me, ndikati something there that I say, I need just the literal meaning of the word. That I say.
I think taking back.
Exactly. Cinema connotations of taking back. You are right on that one. Kurikupa kune connotations of taking back. Saka chinoitika ndechichi kana commissioner uri kuona kuti recoupment income for tax purposes kureva kuti recoupment inotoinclude gross income. Saka chinenge chichinyatsorikupwa commission of taxes ari kuti I am taking back my allowances andakambokupa. I am taking them back. Saka clearly haangaite recoup more than my allowances aakakupa. So notice this particular point. So let us have, say, an asset, and let us have cost, and let us have ITV, or I mean capital allowances, capital allowances, and then let us have ITV. You now know that ITV is the difference between cost and capital allowances, and we now have ITV, and then we have selling price, and then after selling price, what we have, we now have we have what is called potential recoupment, and then we now have actual recoupment. Actual recoupment. Right. So here are the items. This table is the table that I encourage you to compute whenever you are calculating recoupment and the other and this stuff. I encourage you to come up with this particular table. Okay. So I am just coming up with assets like vehicles, let's say lorries, then buildings, then we have got equipment, and then we have got furniture. I'm just coming up with these hypothetical assets. Let's say these are the assets you have. These are the assets. And lorries, they did cost 600, 1, 2, 3. Buildings, 1, 200, 1, 2, 3. Equipment, 8. Furniture. So here now capital allowance is granted. Let's say here you granted 450, 1, 2, 3. Here you granted 500, 1, 2, 3. Here you granted 600, 1, 2, 3. Here you've granted 75, 1, 2, 3. So ITV is the difference between cost of the asset and the capital allowance is granted. This is your ITV. So I can now have this as my ITVs. And now let's say these are the selling prices. The selling price for lorries was 225, 1, 2, 3. Let's say lorries, you sold them now for 550, 1, 2, 3. And buildings, you now sell them for 2,500,000, 1, 2, 3. And then equipment, you now sell it for 400, 1, 2, 3. And then furniture, you now sell the furniture for 250. 1, 2, 3. Sorry, guys. You hit the mute button whenever you feel like you've got background noises. Now, here you are. Here you are. So we want to calculate recoupment. Remember the formula for recoupment. Recoupment is selling price minus ITV. So potential recoupment is this minus ITV, like this. So these are your potential recoupments. But there is this note here that we have just written which says recoupment cannot exceed allowances previously granted. In other words, if you are now calculating the actual recoupment, the figures in the recoupment section, they are limited by allowances previously granted. So take, for example, lorries. Lorries capital allowances were 450 and potential recoupment is 400. So it has not exceeded 450. So we take 400. In other words, we take the minimum. We take the 400, like this one, because it has not exceeded allowances granted. Now let us come to buildings. Recoupment on buildings is 1,800,000, but allowances granted were just 500,000. So recoupment becomes 500,000. It should not be the allowances granted. Equipment, 200,000 is the potential recoupment, and capital allowances were 600. So 200 is not exceeded 600. So we take 200. And then furniture. Potential recoupment is 125, but capital allowances granted were 75. So 125 is exceeded 75, so we take 75. Because recoupment cannot exceed allowances previously granted. So you now know that this is the explanation there. Recoupment cannot exceed allowances previously granted. And this is equally the same explanation there. Recoupment cannot exceed allowances previously granted. Okay, just on this one, just type noted, say, in the chat. I just want to see how many have paid attention to what I've just said. There is a chat feature here in the WhatsApp. If you can type noted, say, just for me to appreciate how many have actually grasped what I've just said, because it's also important. Okay, perfect. Okay, so I can see that we have people in the class, and we have got listening ears and watchful eyes. So that one is fine. Clearly, this is a watchful eye. Well, okay. So recoupment cannot exceed allowances previously granted. So these are the main points to note as we are wrapping up our recoupment. Now, so you now know that capital allowances means tax allowable depreciation. So there should be rates to use. There should be rates for capital allowances. Rates for capital allowances. Yeah, there should be rates that we use for capital allowances, or TAD, tax allowable depreciation. You remember that for accounting purposes, we have got straight line, reducing balance. There are other funny rates. For tax purposes, we equally have the same. So what I'm going to do here is, perhaps if I can open let me open question papers here for tax, so that I can show you the rates that we use for capital allowances. These are the same rates. I'm just opening any paper, but of course with bias towards the recent papers. Because the rates have not yet changed. If the rates haven't changed much, we can just copy the same rates. Sorry, it's opening. Right. All right. Okay, I'm coming to the, we give you the, so in other words, concerning the rates and stuff, it's not something that you should cram, no. Because in the exam, we give you that. So it's nothing like, oh, I know the rates for capital allowance. Even if you don't know them, we give you these rates in the exam. So it's a matter of copying this. That's where I want to copy. Copy like this. And I come to my Excel here. These are the rates for capital allowances. Okay. So because it hasn't copied right, allow me to edit it a little bit. So there is special initial allowance, special initial allowance, special initial allowance, these are percentages. So special initial allowance is 25%, and where accelerated wear and tear is 25%, and then there is wear and tear on buildings, it's 5%. Then on farm buildings, it's 5% again. On commercial buildings, it's 2.5%. Then on vehicles, 20%. On other movable assets in general, 10%. Now the reason why these are like this is because vehicles, vehicles are utilized faster than other machines. So no wonder why vehicles, they've got 20%. So when it comes to the issues of capital allowances, there is something that we need to know. When we say special initial allowance or SIA or SIA, when we say 25%, this is straight line on cost. Straight line on cost. So even if you buy the asset which qualifies for special initial allowance on 2 December, you claim 25% on cost, even if it was just used for 28 days. This one again is straight line on cost. And then reducing wear and tear on industrial buildings. When we say 5%, it's again 5% on cost. It's not reducing balance, no. Straight line on cost. The same here on farm buildings. The same here on commercial buildings. This is not reducing balance. And then when we then say motor vehicles, and this is now reducing balance. And then the other one is again reducing what? Balance. So these are the rates for capital allowances. Make sure you commit these to memory. Even in as much as you forget them, it's not a train smash. We give you these in the exam. So as you can see, I just opened the question paper. I copied the rates. These are the rates. So in your exam, you will be equally given the same rates. Use these rates again. But there is now eligibility criteria that we need to pivot our attention to. In other words, not every asset qualifies for all these. So before I proceed, suppose you want to minimize tax. Which of the two do you claim? Special initial allowance or wear and tear? If you want to minimize your tax burden, do you claim special initial allowance or you claim wear and tear? Can you unmute and talk to yourself? Yes, Adam. Anyone who can hear me, unmute and talk to yourself. Yes, go ahead.
I think I would go with the SIA.
You go with the SIA. You are correct. Why? Why would you go with SIA? Yes.
I don't have a reason why. I'm trying to find how to justify it, but I don't have a reason why exactly. But I think straight line on cost would be no, I don't have a reason.
Okay. You are correct that you go with SIA. The reason is, remember, capital allowances, these are deductions, meaning they are being deducted from your income. So if you go for SIA, you get more deductions. And if you get more deductions, it means you get what? You pay lower tax, because if you get more deductions, your taxable income is drastically reduced and you end up paying a lower tax. So ukanzwa examiner achiti the taxpayer wishes to minimize tax liability, urikutopiwa hint yekuti where appropriate calculate deduct SIA instead of wear and tear. Wanzwa kuti say vati where appropriate, hazvireve kuti every time une choice yekungodeducta SIA. No, there are instances where it is not appropriate. Even wanga uchida kudeducta SIA, it might not be appropriate to deduct it. So the examiner normally gives you a hint. There are various ways the examiner can hint that. One way of hinting it, the examiner can say, calculate the minimum tax liability. Clearly, if the examiner says calculate minimum tax liability or minimum taxable income, you don't get minimum if you don't calculate maximum allowances. You get minimum tax if you deduct maximum allowances. Get that? Or the examiner can say, or the examiner can simply put it and say, the taxpayer wishes to minimize tax liability. You can only minimize tax liability by claiming maximum allowances where appropriate. Okay. So these are other points to note on this particular issue now going forward. Again, points to note. Points to note on these capital allowances table. So important that you note these points. Number one, a taxpayer can only claim either CIA or wear and tear, but not both SIA and wear and tear on the same asset. Wear and tear on the same asset. You get that? You it's like ku accounting au claim a straight line reducing balance zvese pa asset one. Zvingabuda. Kana uko zvichirambidzwa zvinoreva kuti kunoko futi zvinorambidzwa. So another point is depreciation is a prohibited deduction. Depreciation is a prohibited deduction for tax purposes. Deduction for tax purposes. For tax purposes. And in its place, comma, we compute capital allowances. So ukaona pachinzi pakadidactwa depreciation, add back depreciation, woclaim capital allowances instead. Then another is unotoona kuti wakutopedza tax, sei vachingokuticha tax from the head. Zvinokuradza zvinhu zviri easy. Izvi zvofanira kuradza zvinhu zviri easy. Ndinotongokuticha nchingotaura senya apa nanditori kubhawa ilibhira nditori naro iri. Inyaya yengoti chete handisigoni inwangu. But I was actually drinking. So this tells you kuti kana indegawo ndichitichwa nechidhakwa subject randotichwa nechidhakwa naindika kuna nchimboritadza the problem somewhere. Handizvere takunda.
Ndizvo zvese.
Haungati se vanga vachirwa black label juice varingotaura tax iwo ubva watotanga kuti chirega nyatsodzigarira pasi seungori kudzidza wakamira. Right. So we have that. Another point to note is concerning industrial buildings, comma, farm buildings, comma, staff housing, then what do we mean by this? You know, SIA can only be claimed. SIA can only be claimed if such buildings were constructed by the taxpayer. Keyword constructed. We can only claim SIA on industrial building, farm buildings, or even staff housing if they were constructed by the taxpayer. Then if such buildings were purchased by the taxpayer, if such buildings were purchased by the taxpayer, comma, where and tier is claimed instead. Where and tier is claimed. Where and tier is claimed instead. You know, if such buildings were purchased by the taxpayer, then where and tier is claimed instead. Saka iwo ukanzwa kuti munhu akatenga business rine mabuildings, pakangonzi chete akatenga riine mabuildings, haticlaime where and tier. I mean, haticlaime SIA, tinoclaima where and tier instead. Saka rega kungoti nekuti examiner ati the taxpayer wishes to minimize tax liability, iwo bwangofunga kuti panotoclaimwa SIA. Zvinoenderana nekuti mabuildings acho akatengwa here kana kuti akavakwa nataxpayer. Kana akavakwa nataxpayer, SIA inoclaim. Kana akapurchaswa nataxpayer, haticlaime SIA, tinoita kutora marates wear and tear. Zvinonyatsonzwika. and hazvina kana chakaoma, Madam T, haana kana. And then another, it's capital allowances cannot be claimed on land. Capital allowances cannot be claimed on land. We don't claim capital allowances on land, so this one is a simple point. In as much as we don't depreciate land, we also don't claim capital allowances on land, whether SIA or what. So even you can taxpayer purchase a land, hapana futi capital allowances. Note number 5. Note number 5 is SIA cannot be claimed on. SIA cannot be claimed. SIA cannot be claimed on commercial buildings. SIA cannot be claimed on commercial buildings. Ndosaka kuona panapa ndisina kuti ndati panoti number 3 ndati containing industrial buildings, farm buildings and staff housing. Ndasiya commercial building because commercial building haitoclaim SIA zvachose. Wear and tear at 2% is claimed instead. Wear and tear at 2.5% per annum. Per annum means straight line. Per annum on cost is claimed instead. So that's what we do concerning commercial buildings. We don't claim SIA. Let's say, however, comma, if the commercial building is at a growth point area, let's say is constructed, keyword is constructed at a growth point area, then can be claimed. So ukanzi commercial building yakavakwa kuwedza growth point inoclaima SIA kana yakavakwa, kwete yakatengwa, yakavakwa ku growth point, kwete yakatengwa, yakavakwa ku growth point. Now you may say we have heard you, but tell us, what is a commercial building? I'm sure if that word is solved, that puzzle is solved. What is a commercial building? It's an honest question. This one is an honest question. Say we have heard you, but tell us what a commercial building is, because without knowledge of that this is a commercial building, we may end up claiming SIA. You know, a commercial building is a building used for commerce. You know, a building used for commerce. What do we mean by commerce? We mean non-manufacturing building. Those ones we don't use for manufacturing. Non-manufacturing, that's what we mean by a building used for commerce, which we don't need manufacturing. You know, acquired or constructed after 1 April 1975, because that's where we came up with the definition. Acquired after 1 April 1975, and which is not located close to an industrial building. So you may say, give us examples of commercial buildings, say, so that if we are given a building, we can know, like a store, like a shop is a commercial building, e.g. shops, showrooms, warehouses, all these are commercial buildings. You may give me an example of what any example, warehouses, showrooms, shops. One thing to note is it must not be located close to an industrial building. Here, it must not be close. Let me delete the word close. In its place, let me say adjacent. If I say adjacent, it hammers the point I want to. Adjacent. It must not be adjacent to an industrial building. So what do we mean by this? What we mean is, if a commercial building is a shop is located industrial building adjacent to an industrial building. If it's located adjacent to an industrial building, such as a factory, then such a shop is treated as a commercial building. It's treated as an industrial building for tax purposes. An industrial building for tax purposes. So what do we mean? We are saying it can claim SIA where appropriate. It can claim SIA where appropriate. So this point is so important. Quite a lot of very important points. What we are saying, you know what happens if you go to light industry or what, those buildings you find, they are not commercial buildings. Suppose you are now you are in Workington industrial area where they manufacture, say, beds, like KDV bedding. It has got its factory in industrial area in Workington, and you see them displaying those beds in a workshop, or in a warehouse, which is adjacent to the factory. Under the circumstances, that warehouse is not treated as a commercial building because it is located adjacent to the factory. Or say you are also at the factory and there's a shop nearby or an office, where you get to that office and you are given quotations. You say, go to that office and get a quotation. So if you go to the office and get a quotation, and the office is adjacent to that warehouse, to that factory, that office is not treated as a commercial building. It is treated as an industrial building for tax purposes. Now you understand. You now understand that. Now, qualifying costs on certain assets, we call these deemed costs. The commissioner normally, because there are certain assets where the commissioner doesn't want you to qualify to calculate capital allowances on the actual cost. Rather, the commissioner specifies certain amounts to be costs, regardless of the actual cost that you paid. And we call these deemed costs. They are deemed in what way? They are deemed by operation of the law. The operation of the law makes it the cost. So it's like this. On passenger motor vehicles. Passenger vehicles. Passenger motor vehicles. The deemed cost is 100,000. These are Zim dollars. Right? That's passenger motor vehicles. And then on staff housing. Staff housing. Then on staff housing again, deemed cost. Deemed cost is 250,000. So these are qualifying expenditure limits on deemed cost. So what it means is if actual cost exceeds the deemed cost, comma, then capital allowances are calculated on the deemed cost. Whenever we have a situation where actual cost exceeds, suppose you buy a motor vehicle for 1 million. When you're calculating capital allowances, whether SIA or what, you can only calculate it on 100,000. However, for staff housing, no capital allowances are granted for actual cost exceeds deemed cost. Now, so it means the first provision there that we have written, it only applies to passenger motor vehicles. It doesn't apply to staff housing. Imba dzinogara vashandi kana yangovakwa iri more than 250,000 hatichaclaim macapital allowances. Asi ikaita less tinoclaima paactual cost. Ayo madeemed cost anonzi maqualifying cost, meaning maximum costs. Saka iwewe kana ukatenga mota ne80,000 for example, unocalculate macapital allowances pa 80,000. Asi ikaexceeda 80, unocalculate macapital allowances pachi pa 100. I mean, ikaexceed 100,000, unocalculate macapital allowances pa 100,000. Simple as that. Now, perhaps you may say, we have heard you, this is loud and clear. But the question is, what is a passenger motor vehicle? Oh, okay. Pane statement yandataura yandati kuma buildings unoclaima SIA kana akavakwa. Iyi statement yekuti kuma buildings unoclaima SIA kana akavakwa haiapply kuma movable assets. Ma movable assets nyange ukatenga X japu yako unoclaima SIA. This does not apply to movable assets. Ungazoti se matimimi kana takaita zvekuva kuma buildings chete ndokunoclaima SIA kana yakaconstructwa. But ukatenga second hand machinery kwamutare unotoclaima SIA. That is kana uchida kuminimize tax. Kana usingati unoclaima wear and tear nemarates akanyora. asi kana ukatenga iri kambani kwamutare ine mabuildings akaapokara aclaime siya anoclaima wear and tear, but maassets akatenga even ari masecond hand anoclaima siya. So ungati nhaise apa tapanzwa pemapassenger motor vehicles, ma-PMVs nemastaff housing. Imbotiudza kuti chii chinonzi passenger motor vehicle? Passenger motor vehicle. This is again a very good question, because without this question answered, you may proceed to do the wrong thing. What is a passenger motor vehicle? You know, passenger motor vehicle hazvirevi kuti mota inotakura vanhu. Like kuti bus, omnibus. Those are not passenger motor vehicles. They are called commercial vehicles because they are using them for business. So they are commercial vehicles. So you need to understand that. So a passenger motor vehicle, I can define it like a luxury type of vehicle. Luxury type vehicle. Other than tractor. You can't say in passenger motor vehicle room tractor, buses, single cabs, lorries, omnibuses, etc. These are known as commercial vehicles. So all these are known as commercial vehicles. So a luxury, any vehicle which is other than this is called a passenger motor vehicle. Any vehicle other than this. So a Mercedes-Benz is a passenger motor vehicle. So what the deemed cost here, the 100,000, doesn't apply to tractor, buses, single cabs, lorries, omnibuses, etc. That provision doesn't exist on these. So in other words, okay, fine. Then NB, let us have NB here, still on passenger motor vehicle. If in otherwise PMV is used exclusively, if in otherwise PMV is used exclusively for business, e.g. a pool vehicle, taxi, then it ceases a PMV and is treated as a commercial vehicle. Papabata, kana unga uine passenger motor, like ukaenda kumikuzi, ukaona mataxi emikuzi, mabenz, asi anoshandiswa exclusively for business. Saka iwayo haazonzi mapassenger motor vehicle. Anenge akunzi futi ma-commercial vehicles nekuti asina kusiyana nebhazi. Asiyana chii nebhazi kana kuti rori. Asina kusiyana naizvozvo because aungoshanda for business. Saka haasisiri eligible for deemed cost. Asi ukanzwa kunzi pakatengwa twin cab kana kuti Fortuna yafinance direct. Pakatengwa Isuzu whatever KB 300 MD or what. Pakatengwa Range Rover Sport HR. Aya manje ndo mapassenger motor vehicles because haasi kushandiswa exclusively for business. Vanoenda nawo kudzimba. That's private at times. Aya anenge akunzi mapassenger motor vehicles. Kwete kuti company yemabhazi yatenga bhazi haisi passenger motor vehicle, yatotenga a commercial vehicle because ndo mota dzacho dzebasa. Ndo mota dzacho dzebasa idzo. Saka ma commercial vehicles. wapabata ka then ndanyatsopabata ipapa kuti kana ndikati yakutotreatwa secommercial vehicle ndikureva kuti hapasina zvedeemed cost izvo hapasina. Then okay, now ungati imimi sei saka kana asset ine deemed cost zvinoreva kuti commissioner aconsider the actual cost kana yaexceeda deemed cost anoshandisa deemed cost. Ko kana takucalculate recoupment iwo tinoshandisa here actual selling price. Because commissioner angangoti ndinocalculate deemed cost kana achida kucalculate macapital allowance kana ada kutipa macapital allowance. Zvinorevawo futi kuti kana takucalculate profit on disposal hatifaniri kushandisa actual selling price, otherwise tinorohwa mari commissioner because panozobuda mari. Toshandisawo inenge ichinzi deemed selling price. Kana asset qualify for deemed cost, if that asset is subsequently sold, tinocalculate futi inenge ichinzi deemed selling price. So what we have here is like this. If an asset is qualified, if an asset is qualified for deemed cost, when sold, we use deemed selling price to calculate recoupment. We use deemed selling price. Recoupment. Tinoshandisa deemed selling price to compute recoupment. Kana asset ya qualifier for deemed cost, kana yakutengeswawo tinoshandisa deemed selling price to calculate recoupment. So important. Now here's how we calculate deemed selling price. You say deemed price equals, right? You say deemed selling price, you say deemed cost, deemed cost over actual cost times actual selling price. Do inenge ya selling price ya unoshandisa deemed cost over actual cost multiplied by the actual selling price. So this is the deemed selling price. Ndo ya unenge wakushandisa calculate recoupment. Hauchashandise actual selling price. This formula will not be given. It's a formula to learn, to commit to memory, so to speak. It's a formula to learn. So actually, if I can put this in a box, because it's so important. Right. Well, if you can only promise me that you now know capital allowances to this extent, you are right on track. The last discussion item on capital allowance is growth point allowance. Growth point allowance. Oh, containing this, I marked your assignments. I was just going through the assignments. The overall feedback I can give to you is you got the questions right, because it was simply a matter of getting items which we have to include in gross income, and that part you got it right. So there was nothing really much. You were able to actually pinpoint that this was a receipt of capital nature, like the inheritance, lottery wins, and also you were able also to identify that on the royalties the source was in Zimbabwe. On rent from immovable properties the source was outside Zimbabwe. You got that right. So by the points I just wanted to confirm on that particular assignment was, it wasn't a structured assignment per se. It was just an assignment where I was examining you, are you able to calculate fringe benefits? Are you able to identify whether the source is in Zimbabwe or the source is outside Zimbabwe for inclusion in gross income, and also a little bit of annuities there? You got that part right. And another thing is, I also wanted you to identify that is this a income of capital nature or not. So overall, the assignment, you got it right. That was the feedback that you were waiting for. If I had come across something that warranted further explanation, I would have told you. But as you know, this part of the assignment, it still catches up after you have slightly forgotten it in later chapters. We will be expecting you to know this. It is when we are now doing a full question that I will then be giving you bespoke or customized feedback to each and every student. So that one is a good thing. I just noted it when I was about to say something else. There is what is called growth point allowance. Growth point allowance, it's like a commissioner. The commissioner also tries by every means to promote investment in growth points. One way of achieving the same is to give growth point allowance. When we say this is an allowance, we say it is deducted for you to pay. It is deducted from your income. That's what an allowance means. So an allowance is something which must be of use to any taxpayer, because allowances are there to minimize your tax burden. So when we say there is a growth point allowance, we are simply saying the commissioner also has these allowances to businesses in order to promote investment in growth points. So you can say the taxpayer can claim growth point allowance on assets used for business, at a growth point area, in their first year of use. At a growth point area in their first year of use. So what is the allowance? So I said a taxpayer can claim growth point allowance at 15%. Actually, it's 15% on assets used for business at a growth point in their first year of use. So this one is just a once-off. We don't do it the way we proceed with capital allowances, like straight per annum on cost. No, 15% on cost of assets. It's actually 15% on cost of assets used for business at a growth point in their first year of use. So if you are told that this business is also using assets at a growth point, it means it claims capital allowances and also growth point allowance. It claims capital allowances and also growth point allowance. All right. So continuing, let us now look at computation of tax from employment income. Computation of tax from employment income. If